shares in Microsoft has slumped hard overnight with its loss of value close to an all-time record, about 400 billion US.
January 29th, 2026. Microsoft loses $440 billion in market value. In one day, 12% of the company evaporated, the second largest single-day market cap wipeout in United States stock market history. Only Nvidia's DeepSeek crash was bigger, but here's the part nobody's talking about. Microsoft beat earnings expectations. Revenue hit $81.3 billion, record high. Earnings per share came in at $4.14, beat estimates by 22 cents. By every traditional measure, this was a great quarter. Wall Street didn't care. The stock collapsed anyway, because investors finally looked under the hood. They saw what Microsoft has become. Not a software company, not even a cloud company anymore. Microsoft is now an AI infrastructure company, spending $150 billion a year building data centers for a technology that hasn't proven it can generate returns. And 45% of their future revenue depends on whether Sam Altman's startup can actually afford to pay its bills. That's not a business model, that's a bet. And on January 29th, Wall Street decided the odds weren't good enough. The numbers are staggering. Microsoft spent $37.5 billion on capital expenditures in a single quarter. That's 66% more than the same quarter last year. In the first half of fiscal 2026 alone, Microsoft burned through $72.4 billion building AI factories. Their annual CapEx run rate is now approaching $150 billion. To put that in perspective, that's more than the entire gross domestic product of Ukraine. Microsoft is spending the economic output of a medium-sized country every single year. On data centers, on chips, on infrastructure for AI, and what are they getting for it? Azure cloud growth of 39%, down from 40% the previous quarter, down from 43% the quarter before that. 3 consecutive quarters of deceleration. The AI cloud business is slowing down, while spending is accelerating. Consumer News and Business Channel's Jim Cramer summarized it perfectly. It's the collapse of software and the ascent of hardware, and it is staggering. But the real bombshell came during the earnings call. Chief Financial Officer Amy Hood revealed something Microsoft had never disclosed before. 45% of their commercial remaining performance obligations are tied to a single customer, OpenAI. Let me translate that. Microsoft has a backlog of $625 billion in future cloud commitments, contracts that will be recognized as revenue over time. That number sounds incredible. It doubled in a single year, up 110%. But here's the problem. $280 billion of that backlog comes from one company, OpenAI. OpenAI committed $250 billion to Azure services as part of their restructuring deal in October. That's not diversified enterprise demand. That's not thousands of Fortune 500 companies betting on AI. That's one startup, one customer, one single point of failure. Jefferies analyst Brent Thill asked the obvious question on the earnings call. Can OpenAI achieve these financial goals to pay Oracle, Microsoft, and many of the providers? Nobody had a good answer. The OpenAI dependency problem goes deeper than the backlog numbers suggest. Strip out OpenAI's contribution, and Microsoft's remaining cloud backlog only grew 28%. That's solid, but it's not transformational. It's not the exponential AI adoption story Wall Street had priced into the stock. Amy Hood tried to reassure investors. She said the remaining 55% of the backlog, roughly $350 billion, is diversified across customers, solutions, industries, and geographies. Frankly, I think we have super high confidence in it, she said. But confidence doesn't pay the bills. And OpenAI is burning through cash at an unprecedented rate. The company lost nearly $5 billion last year. It's planning to spend even more in 2026. And its revenue, while growing, still doesn't come close to covering its compute costs. Microsoft is essentially financing OpenAI's operations. They're the landlord, the bank, and the biggest customer all at once. If OpenAI stumbles, Microsoft doesn't just lose a partner. They lose 45% of their future cloud revenue. The market reaction was brutal. Microsoft shares fell 4% in after-hours trading on January 28th, immediately after the earnings call. By noon on January 29th, they were down 12%, $440 billion in market value, destroyed. To understand the scale, that's more than the entire market capitalization of most companies in the world. Microsoft lost more value in one day than Walmart is worth, more than Disney and Netflix combined. It was the company's worst single-day decline since March 2020, when the COVID pandemic crashed global markets. The tech-heavy NASDAQ composite fell 2.1%. The software sector exchange traded fund dropped 5%. Bitcoin plunged 6% to $83,000. The shockwaves rippled across the entire financial system. And here's the irony. Meta reported earnings the same week. Their stock surged 10%. They announced they're spending up to $135 billion on AI infrastructure in 2026, even more than Microsoft. But Meta's core advertising business is growing. They can afford to bet big because they're printing money from Facebook and Instagram ads. Microsoft doesn't have that luxury. Their productivity software business is mature. Windows is declining. Gaming is struggling. The entire growth story depends on AI working, and AI isn't working fast enough. The fundamental problem is what analysts are calling the AI return on investment gap. Microsoft is spending faster than it's earning. Cloud margins are compressing. Gross margin fell to just over 68%, the narrowest it's been in 3 years. Operating margin guidance for next quarter came in at 45.1%, below the consensus of 45.5%. These might seem like small numbers. 40 basis points here, a percentage point there. But at Microsoft's scale, small margin compression translates to billions of dollars in lost profit. Wall Street used to give Microsoft credit for future potential. The promise of AI was enough. Not anymore. The market is demanding what analysts call AI receipts. Proof that all this spending is generating returns, accelerating revenue growth, expanding margins, clear paths to profitability. Microsoft can't show any of that. Revenue is growing at 17%. Solid, but not accelerating. Margins are shrinking. And the biggest growth driver in the backlog is a startup that loses billions every year. The historical parallels are ominous. Analysts are comparing this moment to the fiber optic bubble of the late 1990s. Back then, telecom companies spent hundreds of billions laying cables and building networks. They believed demand for internet bandwidth would be infinite. They built the infrastructure before the applications existed to use it. They were right about the demand, eventually. But the timing was disastrously wrong. Most of those companies went bankrupt. The infrastructure they built became assets bought for pennies on the dollar by the survivors. Is AEI different? Maybe. The demand is certainly real. Microsoft says demand exceeds supply. They can't build data centers fast enough. Chief Executive Officer Satya Nadella spent much of the earnings call explaining that Azure is capacity constrained, not demand constrained. But that's exactly what the fiber optic companies said too. Demand exceeded supply until it didn't. Until the recession hit and companies cut IT budgets and the infinite growth story collapsed overnight. Bill Gates saw this coming, sort of. When Satya Nadella first proposed investing $1 billion in OpenAI back in 2019, Gates was skeptical. Nadella revealed this in an interview last year. Remember, this was a nonprofit, Nadella said. And I think Bill even said, yeah, you're gonna burn this $1 billion. Gates was wrong about the investment. That $1 billion turned into a stake now worth over $135 billion on paper. Microsoft owns 27% of OpenAI's public benefit corporation. The partnership made Microsoft the leader in generative AI, but Gates was right about the risk. Microsoft did burn billions, tens of billions, and they're about to burn tens of billions more. The question is whether they'll ever get it back. The Gates Foundation has been quietly exiting Microsoft stock. In 2025, the foundation sold 65% of its Microsoft holdings, $8.7 billion worth, the largest liquidation in the trust's history. Officially, the sales are about portfolio rebalancing and charitable giving. The foundation plans to increase annual grants to $9 billion by 2026. Reducing concentration in a single stock makes sense for a philanthropic organization. But the timing is notable. Gates was selling throughout 2025, before the full scope of Microsoft's AI spending became clear, before the margin compression became undeniable, before Wall Street turned on the AI narrative. Gates also issued a public warning about AI investment hype earlier this month. He said if AI growth spawns solely from investment, that could be a sign of a bubble. The hyperscalers spent $400 billion on infrastructure in 2025. They're planning to spend a third more in 2026. A telltale sign of if it's a bubble would be if all we are talking about are the tech firms, Gates warned. Right now, all anyone is talking about are the tech firms. The capacity constraints Microsoft faces are real. They simply cannot build fast enough. During the earnings call, Chief Financial Officer Amy Hood acknowledged that supply constraints will persist, at least through the end of fiscal year in June. Demand continues to exceed supply across workloads, customer segments, and geographic regions. This is simultaneously good news and bad news. Good, because it means AI adoption is genuine. Enterprises want these services. They're willing to pay. The demand isn't imaginary. Bad, because it means Microsoft is leaving revenue on the table. Every quarter of capacity constraint is a quarter where competitors can catch up. Amazon Web Services, Google Cloud, Oracle, they're all racing to build their own AI infrastructure. And the capacity constraints don't solve the return on investment problem. Even if Microsoft builds enough data centers, even if they fill every graphics processing unit with paying customers, they still need those customers to generate enough value to justify the spend. If AI doesn't make enterprises more productive, more profitable, more competitive, the demand will eventually evaporate. 15 million subscriptions to Microsoft 365 Copilot sounds impressive, but Microsoft has hundreds of millions of Office users. 15 million is a rounding error. AI adoption is still niche, still experimental, still waiting for the killer app that makes it indispensable. The contrast with Meta's earnings tells the whole story. Mark Zuckerberg announced even more aggressive spending plans than Microsoft, up to $135 billion in 2026. Analysts expected $110 billion. Meta exceeded it by $25 billion. Meta's stock surged 10%, Microsoft's crashed 12%. Same week. Same story about massive AI spending. Opposite reactions. The difference is the core business. Meta's advertising revenue is growing faster than expected. Fourth quarter sales hit $59.9 billion, beating estimates by $1.5 billion. First quarter guidance came in above expectations too. Meta can afford to gamble on AI because the slot machine keeps paying out. Every dollar spent on data centers is funded by ad revenue that's already in the bank. If AI doesn't work, Meta still has Facebook, still has Instagram, still has WhatsApp, still has 3 billion monthly users generating cash. Microsoft doesn't have that cushion. Windows is legacy. Office is mature. Gaming is shrinking. LinkedIn is steady but slow. The growth story is Azure. And Azure is 45% dependent on a company that's never turned a profit. What happens next depends on whether Microsoft can prove AI is worth the investment. Not eventually, not in 5 years. Now, the market is no longer rewarding potential. It's demanding proof, accelerating revenue growth, expanding margins, clear monetization pathways. Microsoft needs to show that AI is making enterprises more productive, not just more curious. Nadella said the right things on the earnings call. AI adoption is moving from experimentation to production use. The company has built an AI business larger than some of its biggest franchises. Copilot adoption is growing across the enterprise base, but talk is cheap. $440 billion cheap, apparently. The stock is now down more than 20% from its October peak, trading at 26 times forward earnings. Still not cheap by historical standards. Still priced for significant growth. Still vulnerable to further disappointment if the AI narrative continues to deteriorate. Subscribe now, because what comes next is the deeper analysis Wall Street doesn't want you to understand. The AI investment thesis is being tested everywhere. Microsoft is just the most visible example. Nvidia lost $589 billion in a single day last January during the DeepSeek shock. That was the largest market cap loss in history. Microsoft just took second place. The pattern is clear. Any sign of slowing momentum, rising costs, or execution challenges triggers massive sell-offs. The market isn't evaluating these companies as businesses anymore. It's trading them as bets on the future of technology. Microsoft delivered solid but unspectacular. Revenue beat, earnings beat, Azure grew 39%. Any normal company would celebrate those results. Microsoft lost $440 billion. The OpenAI relationship is particularly precarious. Microsoft gave up cloud exclusivity in the October restructuring. OpenAI can now use other providers. Oracle is already building data centers for them. The $250 billion commitment to Azure sounds locked in, but commitments aren't contracts. Circumstances change. Startups pivot, dependencies shift, and OpenAI itself is increasingly unstable. Leadership departures, strategic pivots, regulatory scrutiny. The transition from nonprofit to public benefit corporation raised governance questions. The company is simultaneously trying to build superintelligence and generate enough revenue to justify its $100 billion valuation. Microsoft owns 27% of that valuation. They're betting that OpenAI succeeds, that ChatGPT becomes essential infrastructure, that Sam Altman's vision translates into recurring revenue, that the billions in compute costs eventually generate profitable products. It's a reasonable bet. OpenAI is the leader in generative AI. ChatGPT has hundreds of millions of users. Enterprise adoption is growing. The technology is genuinely transformational, but it's still a bet. And 45% of Microsoft's cloud backlog depends on that bet paying off. The broader implications extend beyond Microsoft. If the world's most valuable technology company can lose $440 billion in a day, nobody is safe. The AI boom that powered the stock market for 3 years is being repriced in real time. Wall Street's faith in artificial intelligence isn't gone, but it's conditional now. Show me the revenue. Show me the margins. Show me the return on investment. The days of unlimited patience for spend now, profit later are over. 2026 is shaping up to be the year of AI accountability, the year when promise meets reality, the year when investors stop asking what could AI become and start demanding what has AI delivered. Microsoft's $440 billion wipeout is the warning shot. The market is saying, we believed you, we gave you time, we funded your infrastructure build-out. Now show us it was worth it. While Microsoft was losing $440 billion, while analysts were questioning whether AI spending would ever generate returns, while Wall Street was repricing the entire technology sector, one fact remained unchanged. Microsoft still spent $37.5 billion on AI infrastructure last quarter. They're still planning to increase spending in the second half of 2026. They're still racing to build data centers as fast as humanly possible, because the alternative is worse. If Microsoft stops building, they lose the AI race. Google wins. Amazon wins. The entire growth narrative collapses. The company becomes legacy software, slowly declining, eventually irrelevant. Satya Nadella has no choice. He has to keep spending, keep building, keep betting, even as the stock crashes. Even as margins compress, even as investors lose patience. That's the trap Microsoft built for itself. They're too invested to stop, too committed to change course. The only way out is through. Spend more, build more. Hope the demand materializes before the money runs out. $440 billion in one day says the market isn't sure they'll make it. That's not a bug in the system. That is the system.